I'm still long Microsoft and Google and short the rest of big tech, so I'm fine with it.
There you go.
So, back to the stock price.
Chamath, do you think that the Google long Netflix short play is the right play?
I think the best trade on the internet, the most obvious, simple money making trade is long Microsoft, Google, short big tech, short the rest of big tech.
Short IBM, short Netflix.
No. Short. No. Meaning you can very comfortably short Apple, Facebook, Amazon, Netflix, and be long Microsoft, Google. So as a spread trade,
right.
It's the best risk parity trade on the internet right now. I mean, period, in the markets.
Can you explain a spread trade?
So look. I tweeted this a while ago, but it's like, and again, I think like. Well, let me be constructive and say the people on Twitter that respond to these threads are not totally stupid, although I think they're kind of idiotic. I said, here's how you can effectively, I said something about, big tech, and I said, I can comfortably put my short on. And I'm kind of trolling people when I do that because I'm not telling them the full trade. And the real trade, whenever you put anything on, in my opinion, is all about managing risk. And the best thing about the internet and the stock market is that, when you're betting on internet stocks, you don't necessarily have to be naked long or naked short, which comes with a lot more risk than if you were long one security and short another against it. So for example, over the last 10 years, you would have made a lot of money by being long Amazon and short a basket of traditional commerce companies, offline commerce. I'm going to make up a basket, but Macy's, JCPenney, Kmart, Sears, right? So if you were short those and long Amazon, that's what's called a spread trade. You're basically playing the gap between your longs and your shorts.
It's independent of where the market generally trades. Is one of the key
irrelevant
points.
Of the market.
Right.
You're basically
because
saying
those stocks could go up, but just not
everything
anywhere near
right.
Amazon.
Yeah.
When you put that trade on, for example, it's I'm going to bet that if everything goes up, Amazon will go up more than Kmart, Walmart, Sears. And if the stock market goes down, Amazon won't go down that much, but these ones will go down a lot. And you're playing the spread. So just to be very explicit, there was and I talked about this last week, but this idea wasn't mine. It's a borrowed trade from somebody who's a very well-known hedge fund manager who put it on in massive size. And, to be honest, not knowing much of anything, I just copied it. But his initial trade was long Google, short Facebook. And that trade basically was at parity, which meant that the long and the short canceled each other out for about the last 4 years. Until the last year, it completely blew out and it returned about 85%. So if you had put $100 in, you would have made about $85 on this trade by being long Google, short Facebook. The bigger trade at scale is actually long Google and Microsoft and short the rest of big tech. And there's a lot of vagaries why that this idea makes a lot of sense. But
what you're saying is they'll outperform the other basket of tech
on a relative basis. So
it's not like you're saying Airbnb can't go up or Facebook can't go up. It could. It's not going to go as much as those other two.
He's saying that the $1 trillion market cap companies, not the Airbnbs.
Oh, okay.
And the reason why focusing there makes sense is they're hyper liquid markets. They have tremendous ways in which you can have massive size on. So you could put a trade of 10 billion long versus 10 billion short. I mean, you can put mega size on these things if you have real conviction. And then the third thing is when the banks look at that kind of position, they actually, from a risk management perspective, treat it differently than if you were just naked long any one of these things. Or
naked long would be just making one bet.
Yeah, or naked short, which is even more dangerous. So
because if the market collapses by 30%, both stocks might go down 30 roughly, but one will go down 32 and the other one will go down 28. And so you're only
down
2% as opposed to the 30%. So all the market risk is taken out when you make trades like that.
Yeah.
The reason it's possible also today to do so at such a scale, right, Chamath, is interest rates are so low. So when you borrow on margin to go long, the rate is very low. And when you short the stock, if it's a highly liquid stock, it doesn't cost a lot to borrow to short.
That's right.
So your actual, carrying cost on that trade ends up being pretty low relative to the upside you expect.
So just to give you a sense of it, my, when I tweeted that tweet out, to complete the picture, I was actually long something against my proposed short. And I put it on in pretty meaningful leverage. And it's worked out really well because I was playing the spread. I was basically betting that, the safest company on the internet today is Google, because they're both a platform company. And to the extent that they're at risk at being an app company, the risk is to Apple, but because they pay Apple so much for search, they're inoculated. And so in many ways, Google is the safest. And it's also, as we've said before, the purest money-making machine on the internet.
You're referring, of course, to Google paying Apple $10 billion to be the
Correct.
default search in their
They own Android, so one platform. And on the other platform, they pay them so much that they're going to be always protected. And the second best company is Microsoft. And we even saw it, by the way, this past week. I don't know if you guys saw that, but Microsoft decided to take a broadside attack against Notion, which is a productivity app that's been growing very well. I felt this when I was on the board of Slack. When Microsoft put its gun sights on us, we always thought that they could not outcompete with us. And what it turns out is when you have a massive distribution advantage, feature parity is enough, and you can actually be slightly less than good enough on the features because distribution and bundling and packaging overpower a customer's desire to adopt a product. So in the case of Slack, it was very difficult, I think, for us to compete against Microsoft's bundling of Teams with all this other software that they were selling, and all the discounting that they could do made it very difficult for us to compete because we had a single product. And lo and behold, 18 months later, the only real long-term protective solution for Slack shareholders was to basically get bought by Salesforce so that you could be part of a bigger whole. This past week, Microsoft decided to go after Notion, and it's going to be, I think, a very similar story where, once they decide to sort of go after this, a product experience, they only need to be 80% as good. And then the distribution and bundling and packaging will take care of the other 20%.
It doesn't kill the other company, but it creates headwinds that
massive headwinds, because a company like Notion cannot be fully valued over long periods of time simply being an SMB company. At a minimum, you'll have to move into the mid-market. You may necessarily never have to go to the enterprise, but you probably have to go to the mid-market. And in that is a very troublesome path because Microsoft has so much, so many tentacles inside of those businesses. So anyways, the long Microsoft, long Google is a pretty obvious kind of like monopolistic, pair trade. The question is, what do you short against it so that you can take out the market volatility and you can play spread? Again, Apple has severe, headwinds with respect to inflation pressures, and margins and supply chain issues. Amazon has pretty meaningful headwinds now relative to pricing power and competition. Facebook has pressure with respect to regulatory oversight.
I think I just came up with one. What about Airbnb versus the airlines? You're talking about spread trade? You're
talking about smaller rinky-dink ideas.
Well, listen, I'm not playing the same chip stack as you. I wasn't there on Tuesday night. I'm on a Thursday night. So would that be a good spread for me?
No, that's a stupid idea, and I'll tell you why.
Okay.
If you're going to put these things on, go to where the deepest liquid markets are because those are the safest.
Okay.
Right? Like don't try to be different. Being the same here.
Well, tell me why Airbnb, which is an incredible margin business that's incredibly well run and growing, versus airlines, which are horribly run and low margin, why wouldn't that be a good spread trade? I'm just thinking out loud here.
I think it's a very, very you're picking two random companies out of a hat.
Well, no, they're both in transportation and vacation and travel.
They're completely different businesses with completely different motivations, with different capital pools, with different people that own the stock. There's no point trying to get cute on these things. My point is, if you really want to be hedged against market risk,
got it.
Go to where it's safest. Find the simplest, most obvious thing. Don't overthink it or don't put it on. So another obvious one, here's it. So obvious is within big tech, figure out which ones you want to be long, which ones you want to be short. That's a spread trade that over the next 4 or 5 years, where if you expect a lot of market volatility, it makes sense to maybe put some of this kind of stuff on, right? A different version of this idea, which makes sense, is in autos. Again, trillions of dollars of market cap, and you can make a decision. Do I want to be long Tesla, Lucid, and Rivian and short the traditional autos? That could be a trade. But trying to go after, let me pick Airbnb versus United Airlines is too random for me, and I don't think they're correlated enough for it to make any sense.